Hello, ladies and gentlemen. Welcome to Triple N Media. I am Nick Nickham. In this presentation, we are going to look at historical stock market crashes, what we can learn from them, and what safeguards we need to take in the year 2021 and 22 for any foreseeable market crash. In this presentation, we're going to focus on stock market crashes, history, and safeguards in the year 2021. The agenda for this presentation is stock market crashes, history, lessons, and safeguards. We're going to look at the historical timing of these market crashes, what precipitated these market crashes, how long it took for the market to recover from the crash, what did we learn from each one of these crashes, what safeguards have been put in place to prevent similar challenges, what safeguards you have to put in place to protect your retirement nest and your investments. The next crash could be coming this month, next month, this year, or could be next year. But it doesn't matter. We need to be ever prepared for a market crash. And I'm going to give you all the tips on how to protect yourself for an unexpected market crash at any time during the lifespan of your portfolio. This is a historic chart. Experts go back to this 1929 market crash called the Black Tuesday that dropped the market more than 90%. And this took many years to recover. It took like several years to come back to its pre-crash level. Then in the 60s and 70s, we had several market crashes. One of the more recent ones is the 1987 market crash. After that, we had the big one, the 2001 dot-com bubble burst, and that was followed by a 2008 real estate bubble. Then we had a 2018 financial collapse, and of course 2020 the corona crash, or some people would like to call it as COVID-19 pandemic crash, but I think corona crash is a very compact, concise description of that crash we had last March, just about a year ago. All right, let's look deeper into these charts and see. Now here is a chart of the 1929 crash. It's called the Great Market Crash of 1929. It led to severe depression. The market lost more than 90% of its value. It took more than 25 years for the market to recover. It is exceedingly important to understand this concept that it may take 6 months or a year for the market to drop, or maybe 2 years, but sometimes it may take decades for the market to recover. When such is the circumstance, you have no chance of protecting your retirement asset. That's one reason why we need to study the stock market crashes in the past, how they behave, how long it takes them to recover, and what steps we need to take to protect our assets from melting down during a market crash. This was also followed by huge economic impact all across the country. There was 25% unemployment, and last March, when we had the corona crash, the unemployment was more than 20%. But within a year, the unemployment has dropped to 6.4%. So it varies vastly from one crash to the other. We don't know how the next crash is going to behave, but taking these lessons, we should be prepared just like we prepare for hurricanes. You see, I live in Texas. I've been living in Texas for 40 years. Of course, I'm living in the Gulf Coast that is Houston. I have faced maybe 20, 30 hurricanes, and we always prepare for hurricanes every year because we know these hurricanes are going to come. It's not a question of are we going to get another market crash? Yes, indeed, we are going to get another market crash. It's just a matter of time. Is it this year, next year, or 10 years from now? But it is going to happen. But we need to be prepared for this in advance. Otherwise, we are going to lose most of our assets. At this time, the Glass-Steagall Act was introduced in 1933 to protect the markets. They also introduced FDIC and SEC, which regulate the stock market industry. That's as far as the great market crash of 1929 history is concerned. Let's continue with the next one. The next one was this stock plunges to 508 points, a drop of 22.6%. Huge volume, 604 million shares traded. We just had a billion shares traded in AMC stock one day, and same thing with GME. But it shows you the difference between what we are today and what things were back in, this is 1987. This is the market crash of 1987, where the market dropped by almost 33%. This was created by the oil crisis, Iran tension, and computerized order entry. Because the computerized order entry was introduced, people were able to just enter orders left and right, and as a result, the systems were jammed. And of course, the oil crisis and Iran tension hit the market straight down, and as you can see, the market dropped in a matter of just months, less than a year. The market dropped its value by 33%. It took more than 2 years to recover, which is very good compared to the Great Depression, which took more than 20 years to recover. See, that's the key. Okay, market drops, and hopefully you have saved some of your assets, but how long is it going to recover? How long it's going to take to recover your original value of your retirement nest? And it is during this time they introduced the circuit breakers, and Fed Chair Alan Greenspan ensured liquidity in the market, and maybe all these safety precautions prevented a recession in 1987. Just like plane crashes, when we see a plane crash, we study it thoroughly and put all the pieces together, recreate this scenario, and find out how we can prevent another instance like that, or what lessons did we learn and how we can improvise that. If it's a problem with an engine or a bolt or like a hydraulic system. And that's what we are seeing in these crash markets, and also lessons we are able to use in the future events. Here's the dot-com bubble. You remember in the 1990s, everybody would come up with a program and they will turn into a billionaire. It's just like magical. And everybody had a little idea which many people were able to turn in, and all this, the big companies like Microsoft and Apple and Adobe, they just gobbled up all these mushrooms that were creeping up from all over the country, and they became the big monoliths that we have today, namely Google, Microsoft, even Amazon and Adobe, NVIDIA. So the dot-com bubble was brought on by this euphoria of becoming billionaires with just one simple idea. And then when the stock market collapsed, the market lost 70% of its value. And from 2000, it took 17 years for the market to get back to the price where it was before. Here we are in the technology era. Here we are where we are most sophisticated compared to when we were in 1920s and 30s. It took 15 to 17 years for the market to recover. So let us keep that in mind, because we never know when the market is going to hit, how badly the market is going to hit, and most importantly, how long it's going to take to recover. When you're talking about 20, 15, 17 years, that's like a third of a productive life. That's probably less than the time left after our retirement. So we cannot afford to wait that long to get our money back, because that is not an option. Okay, let's look at, we looked at the dot-com bubble here. As we can see, the nice drop here. I told you it took a long time to get it. Then in 2008, we had the housing bubble. In 2005, 6, 7, anybody could get a loan. Even if you didn't have a job, you just need to fill out a paper application. Nobody is going to check your application. They will just approve your loan, and then you have a loan with the mortgage company. They put all these loans into a basket. They sold it to a bigger investor, and the bigger investor was left with an empty basket because there was no market value in those, and that caused the housing bubble collapse. There are a lot of things that happened that were bad to the market, but also bad for business. Lot of steps were fudged in order to get people who didn't qualify for a loan to get loans. And that caused a significant drop in the market here. As you can see, that was a pretty big blow for the market. Let's look at some of the other things here. This is again an expanded chart of 2008 market crash, the real estate bubble. I hope we never see that one again. The housing starts, which were just booming because people were buying houses with no money, and it didn't matter because it was all paper world. The housing starts dropped from 2 million in 2008 to like less than 500,000. That's 75% drop in the housing starts. And similarly, the losses were more than 50% in the S&P. And it took almost 5 years for the market to recover from the real estate bubble. Let's move on. Here's the housing bubble and the crash, and it took so long to recover. Let's look at the next one. Back in 2018, we had the financial crisis. There we had the houses. Now we have the savings and loans, which are just loaning money to anybody and everybody with no absolute credibility. And next thing you know, they all became toxic assets because they thought just people owe money on the paper, but they all have no money. So how are they going to get it? So the financial market collapsed, and that took like 9 months to recover. And that brings us to March 2020, which was totally unexpected. It was a natural disaster of global proportion, and that's coronavirus pandemic. And there the market dropped precipitously in a matter of just about 30 days. This is the fastest the market has ever dropped compared to most other market crashes in the past. And with this market crash, we also saw another important factor, that is this market, which crashed as much as it did, it recovered within 5 months the pre-crash value. This is historic. There's no other crash that matches this particular V-shaped curve, because most other ones took like years to reach the bottom and years to reach the top, but here the whole thing was finished in a matter of like 6 to 7 months. Not only did it finish there, and in the next 7 or 8 months, it almost went up by like 160, 170% of where the market was before it crashed. So now let's look at a much broader picture. We looked at individual market crashes. And here is a prediction based on what is called the 20-40 year cycle for major stock market crashes. Back here, we had the major stock market crash of 1930s. That's the 40-year cycle. Then in 1980, we had another major stock market crash, and they are predicting 2020. We expect to see another major hit to the stock market. And if you look at the 20-year cycles between these two, you get a minor crashes, as we see here in 1963 or 4. Then, of course, here we had the dot-com bubble, and this was followed by the real estate bubble here. Corona bubble came, and it's not even marked here because this is probably an older chart. And of course, following that, that's one of the reasons I am doing several videos on possible market crash. Not that I am a cynical person. I'm at a stage of retirement, so I want to make sure I save every dollar I have earned. I have earned it the old-fashioned way, as seeing one patient at a time as a doctor. So I can't afford to lose a single dollar. That's why I'm making these videos, so that we all can learn and become more educated and safeguard our retirement nest. Let us continue with this. There is another stimulus that is fueling the final blow up top phenomenon in the stock market. And that is the stimulus check that were sent to individuals for the recovery from the coronavirus pandemic. The stimulus money amounted to $242 billion. Now, let's look at this data on how much cash inflow was coming into the stock markets and even Bitcoin. I can't believe, you take a stimulus check and put it in Bitcoin. But anyway, 2 weeks before, the amount of money going into the equity market was $16.8 billion. 1 week ago, after people had the money in their accounts, the money going into the equity markets jumped to $56.8 billion. That is almost $40 billion more than what it was 2 weeks ago. At this rate, there may be only 3 or 4 weeks left before the stimulus money is going to evaporate into the stock market blow up top. I mean, that's my speculation, because obviously people are going to spend some of that money. They're going to save some of that money. And when we say save, they're going to put it in the stock market thinking that they can recover, they can make some profit from that. But unfortunately, they may be getting into a point when the big money is trying to get out of the market. That's why I think the next few months are going to be crucial to watch all the indices like the Dow Jones, the S&P 500, and of course NASDAQ has already taken a beating, and it's struggling to see if it can regain some of the loss, but it all depends on how much there is pressure in the market to go down. We don't have to worry about market going down. If we put certain safeguards in our investment system, and I'm going to talk about how we can safeguard our investment. And in fact, we can make money during these market crashes. Let's look at it. When we had all these multiple stock market crashes, the SEC came up with 3 circuit breakers: level 1, level 2, and level 3. Level 1, if the market drops 7%, the market trading is halted for 15 minutes. And this is during the market hours from 9:30 to 3:25. And the same thing if it drops 13%. There should be something more than that, but I couldn't find it. Anyway, if the market drops 20%, if the S&P or Dow Jones drops 20%, kaput, the market is closed for the day. When the market drops 20%, you know the news is not good. The news is not going to disappear tomorrow. It's like an accident. The news will be there for the coming days, months, and maybe years. As a result, we need to wake up and try to do what needs to be done. How do you safeguard your retirement funds? That is the key. It doesn't matter what the SEC puts in place. It doesn't what the government does to give low interest rates, reduce inflation, reduce cost of goods. All those things doesn't mean anything unless you have some safeguards for your retirement nest. And I'm going to talk about how you need to address that. Here are some tips I want to tell you, because I've been through at least 4 or 5 market crashes. I was there 87. I was there 2001. I was there 2008. I was there 2018. I was there last year, March 2020. First of all, when a market is crashing, you cannot reach your broker. You cannot place orders because the computers are jammed. If you put a limit order, it's probably never going to be hit, because by the time they process your order, the price is already way below that. If you put a market order, you may lose your entire shirt, if not your pants. Well, you could, that one too. So how do you protect yourself? precaution. The time to address the dilemma is before the market crashes. It's like being ever prepared for a market crash. That means if you have assets in especially tech industry, you always have some stop gaps. Okay, if the market drops 10%, I am out. My loss is going to be limited to 10%. See, it's just like a house getting on fire. When the market crash is happening, it's similar to a house on fire. That's not the time you want to go inside the house and try to salvage something. No, you're going to get burnt. So I would strongly feel this is what I would do. I would put 5 or 10% like stop loss orders, so that if the market for any reason crashes today with no sign, by the time I hear the news, maybe it's down 15%. At least if I have a stop at 5%, my loss is going to be 5%. My order is already in the computer, so I don't have to worry about computers jammed and I can get through to the broker or through the website. Those things must be all out of our mind altogether. Place these stop orders, and also make sure you limit your loss to what you can live with. Some people may say, okay, even if it drops 30%, I can just sit on it. In fact, when we had the recent market drop of 14% in the NASDAQ, the ARK expert Kathy Wood said, she's going to just sit and wait out. Maybe she's right. It's coming back. But we don't know if it's going to continue to come back or if it continue to then turn down south. If it happens, then you're going to lose a substantial amount of your assets. When you hear people smoking, talking about market crash, it could be coming, it could be happening, it could be this month, next month, or next year. When you hear it from multiple sources, you need to pay attention. Then you look at some real numbers. The real numbers, I will tell you, are interest rate. If the interest rates are going, it is bad for the stock market. If the inflation is going up, it is bad for the stock market. If the Fed increases the interest rates, that is bad news for the market. And in that way, you need to follow important events. Don't ever pay attention to all these talking heads on the main media who will tell you, oh, this is the greatest time to get into the market because the market is all going with so much fraud. That is a misguided message in many cases, because they're telling you to get into the market because the big money is trying to get out of the market. They need buyers. And when you go and spend all the $242 billion in the market, when the market is at the top, you know what's going to happen? There is no more buyer and the market is going to come down. That's math. It's not even psychology. Pay attention to what is happening in the financial markets. Don't listen to all these opinionated people, talking heads, because they could be giving you a wrong message. They could be, selling the stocks in the back and telling you to buy the stock, because the more people try to buy this, they can sell it for a higher price. You get it? Before I conclude, I want to tell you I have a few more ideas on how to protect your assets and in fact make money during a market crash. And this is a video that talks about how we can make money using ultra or ultra short exchange traded funds. And here you can protect your money by using multiple approaches, like using covered calls or puts or using ETFs. So market crashes are an integral part of a stock market. It is not a question of if it's going to happen. It's a question of when is it going to happen, and if it happens tomorrow, are you prepared? I hope this will give you some excitement about getting prepared for any eventual situation. It's just like the airlines prepare for every eventuality. We need to be prepared for a market crash if we are in the market for any reason whatsoever. If you are in the market to make money, you need to protect yourself from losing money. That's the step number one. So I would say just put your safeguards, your protections, and then worry about making profit. Thank you so much for watching this presentation. I hope this will save you some money. If it does, Please leave some comments, and then please do subscribe to our channel, and we bring you more and more information and educational material so that you can protect your assets and make some profit even if the market is crashing. Thank you so much.